Thank you very much. Thanks very much for the introduction. And I'd like to start by thanking the organizers for the kind invitation they extended to me to give this talk today. It's a pleasure for me to be here, and I'm really happy about the opportunity to discuss some of the insights we've been gaining from some research exercises in recent times. So my name is Gbenga Ibikunle. I'm with the University of Edinburgh, where I research in financial economics. This is about some of the trends we're seeing in financial markets, in the capital markets in the markets for capital, both public and private, in recent times. So it is based on a report that I did for the All-Party Parliamentary Group in the UK Houses of Parliament sometime in 2020. So the parliamentarians were keen to understand why we were seeing a decline in the number of listed companies in the UK public markets, and not just in the UK public markets, globally, really, as you will see from the data. So they asked me to look into this, so I put together a team to examine the reasons. So the insights I'm presenting today are based on that work, so I needed to say this upfront. Right. So this is how we went about gathering the evidence we needed for this. We gathered some primary data as well as secondary data. A lot of our work was based on analyzing big financial data from quite a lot of databases. But we also took the opportunity to speak to people who are in the know, who have been making decisions regarding a company going public or not, or a company that has been public, the listing from public markets to go private. There are lots of reasons why companies make these decisions. We needed to understand this, so that's why we gathered primary data as well to look into it. So I'm going to show you a few slides now with some charts to try to set the stage for this. This is the first chart I'd like you to focus on. In there, you can see the number of listed companies we've had in the UK for the past 35-something years, as well as the number of delistings we have had as well. Then we have the number of new companies in there as well. So there are a few things that I'd like to point out here. The first one is the fact that we have had a picking of annual listings in the UK since 2000. What we have been seeing in recent times is a decline in the number of companies that have been listed. And if we take a longer-term approach to look at that, we look at the decade between 2000 and 2009, we had about 150.5 companies listing on an annual basis. And if we look at the very next decade after that, the number has fallen to 82.2. That is a 45.38% decline, suggesting that more companies are not going public, or companies that are public are delisting from the public markets. So the number of UK listed companies peaked in 2006, and by 2019, when we were looking at this data, we had only a little over 2,000 companies. And this is the second chart. This shows you the trends a little bit closer, the trends in new listings, the listings, and net listings in the UK. The net listings have remained positive since 2010, as you can see with the red line. It has remained positive since around 2010. But what this chart doesn't show is that most of those companies are tiny companies. They are small companies that are going public in the UK. The major companies that we expect to see listing in a major market like the UK, we are not seeing them. Now, let's compare this to what is going on elsewhere in the world. So we now looked at the context, including France, Germany, Hong Kong, and the US. And you can see that this is not a UK phenomenon. This is a phenomenon that is actually global in its development. And there is nowhere where this is more pronounced than in the US, where in 2019, we had just over 4,000 companies listed in the US, the largest economy in the world, and the country that is responsible for more than 50% of the global size of capital markets in the world. That is about half the number at its peak in 1996. The net listings fell about 74% between 1993 and 2019. So the UK's position is looking stronger than the European partners, but this is a global trend. What we're seeing is nothing that we can ascribe to a specific country. So we expect to see this in emerging economies as well, if we start looking at the data from those places. But there is something that stands UK out in here, is the fact that even when companies are going public, they are not big. Other markets are becoming more attractive to even companies coming from the UK. For example, we have Hong Kong that benefits from its proximity to China in attracting big Chinese firms to list on its exchange. But it has also attracted non-Chinese listings as well. We've got Rusal, for example, 2.2 billion. That was done, I think, in about 2018. Prada, 2.14 billion IPO. And Samsonite, 1.25 billion IPO. Those are not traditional Chinese companies. Those are European firms that are going to list, that are basically looking away from London and going to list in Hong Kong. It's an interesting scenario, but let's now backtrack and try to understand, first and foremost, why will a company go public in the first place? Most companies start small. All companies start small. And as you grow, normally, if you're lucky enough to grow, you start facing increased risk because you're growing bigger. And in order to diversify that risk, because you don't want to take on that risk all by yourself, you start looking to dilute ownership. Then you go to the public market, potentially, in order to dilute public ownership. What we are seeing is that companies are now looking elsewhere. They're not going public. They're going into the private markets as a means of diluting the ownership, that is in terms of the owners of those companies. They are looking to private markets, but of course, there are other reasons why companies go public. This one is very popular as an exit for early investors and managers in a business. Many companies will go public just so that they can provide an exit strategy for the early investors as well as for the managers in those companies. So, and this is an important factor that makes going public not an option for many companies. A lot of companies these days have intangible assets that are critical to their value. The knowledge and tangible asset that they have is what encapsulates their value to the market. And if you are going to go public, you're going to have to divulge some of that information to would-be investors, because you will have to provide, there are disclosure rules, disclosure requirements that are in place in public markets. So you will have to divulge this information. It's quite risky, because this is what captures exactly how useful your company is, how valuable your company is. So many companies choose not to do that, and they choose to stay in the private markets. It is possible for them, for example, to find a few well-heeled, a few very rich investors who can invest in their businesses rather than going into the public markets. And that has led to the rise of another phenomenon, which I'm going to talk about in a little bit. So, as I said, we are seeing a rebalancing of the value of companies away from things like machinery and buildings, tangible assets that we can lay claim to. For example, in the past, when a company achieves $1 billion valuation, we'd expect them to have a strong footprint in terms of machinery, in terms of buildings, and lots of stuff. But now that is not the case. There are lots of companies that are achieving billion-dollar valuations that are characterized by low numbers of employees, lack of revenues and profits. Basically, they are not making profits just yet. And many are still not able to point towards a very viable source of revenue as well. And the short period in which they achieve the $1 billion valuation is also another thing that characterizes this kind of companies. There are a few examples here. A very popular one is ByteDance, which is the owner of TikTok. They have $140 billion valuation right now, achieved within a couple of years. Didi Chuxing, which is also another Chinese billion-dollar valuation startup company that is no longer startup by definition, to be fair, has a valuation of $56 billion. Airbnb has a valuation of $18 billion. All these companies are not going to the market to achieve this valuation. They're doing it in private markets. And so the story is changing. In the past, we'd expect a lot of companies, as they're getting bigger, to start going to the public markets and to start disclosing a lot of information. But these guys are choosing not to do that, to stay within the confines of private markets. So the most valuable companies in the world today are fueled by what we know as knowledge intangible assets. And companies all over the world are investing significantly in research and development in order to be able to capitalize on this. And those yet to be proven intangible assets, it's difficult for non-specialist investors like you and I, for example. I've been listening to guys talking about cloud computing here and cloud storage here all day, and I don't know too much about that, but if one of those companies they've been talking about goes public, I might want to invest in it. My valuation of those companies may not be true to type because I don't understand the business just enough. So this is a problem for new companies looking to diversify the risk and dilute ownership. So they'd rather do it in private markets, an important thing that we have found in our research. And one other reason why private, small companies, emerging companies may choose not to want to go into the public market is the cost. They face much higher costs to go to the market in the first place, but also to stay in the market. There is a lot of cost that is associated with that. There is a survey that we looked at in the course of this research, put together by PwC and Oxford Economics. The CFOs of the companies that were included in the survey estimated that going public increased their cost by 32%. That is almost a third of their costs. And that is just because it costs a lot of money for you to be able to go public in the first place, but also to adhere to the rules of being a public company. We looked at SEC filings for US IPOs as well. That is also very expensive, issuing IPOs. If your IPO has a value of between $25 to $99 million, you can expect it to cost you up to $13.9 million just to go public in the first place. The money you pay to all those investment banks for the roadshows and so on. It is massive endeavor. And for the largest deals worth more than $1 billion, you can expect to spend, in some cases, up to $149 million. That is based on SEC filings from the Securities and Exchange Commission in the US. But there are still reasons for companies to want to go public, because if you have robust regulation that these companies have to adhere to, it makes them attractive to international investors. For example, I invest liberally in UK companies because of the robust regulatory environment. So we looked at this, and we used data from the World Bank to measure the rule of law, and we determined that the quality of the UK regulatory environment is linked to a 19.66% increase in the number of UK IPOs over the 35-year period that we looked at. So there is some benefit to it, despite the fact that it can be quite expensive to be a public company. We are also seeing evolving investor attitudes. A lot of investors don't want to wait for the long term to reap the profits of their investment. They are only waiting for the next quarter. They are always looking to the next quarter. And I do the same. Basically, my investment app, I'm looking at it at the end of every day. How much did I make today? So that is a problem. I am a problem. The average public investor is a problem for a dynamic and small company that is looking to make money in the future. And for good reason. The strategy may be sound to play to the long term, but they can't do that when investors are breathing down their necks, always analyzing all of their predictions for the next quarter earnings. You saw what happened with Netflix. Netflix user base dropped just for a couple of quarters, and you saw the rout in Netflix stock prices. And that's the kind of problem that these companies are facing. So investors increasingly want to earn profit on their investments very quickly. And this short-termism, we identified as perhaps the biggest factor in emerging companies not going public, deciding to stay private. So the investor focus on short-term returns is to the detriment of company value, and it has given rise to a trend of acquisition of public companies by international specialist investment vehicles. So we are seeing a lot of companies coming from places like the United States, for example, taking over companies in the UK. Now, this is an article in the New York Times. I gave some comments in this article, and it also reviewed the report on which this presentation is on. And what the article was trying to say is that because of this issue of short-termism, of investors' expectations, a lot of companies are not well valued, because when investors see that you are not making money quickly enough, they start selling your stock. And as they sell your stock, the value of your stock falls. When the selling pressure outstrips the buying pressure of the stock, you can expect to see a fall in the price. Sometimes it can be precipitous, and it can spell doom for a company. And when that happens, what occurs is that you see private equity, special investment vehicles coming from places like the United States and China coming up to buy companies. This is a trend in the United Kingdom right now. And it's not just in the UK, it's happening in different climes all around the world. So here are some quotes that we got from some of the people we spoke with. And you can see they are very highly placed C-suite executive cast members in their different companies. So we are seeing the rise of private equity funds. These private equity funds, they go into the public markets and they take companies private. They also ensure that companies that are already private, that are innovative, that can perhaps have strong long-term prospects, they are also investing in them and helping them to stay private longer. So in the past, about 20, 30 years ago, you'd expect a major company that has already shown that it can make revenue to start thinking about floating an IPO. That's not happening anymore. What's happening now is those who already floated an IPO are actually coming back into the private fold. There was an example that I was going to give as part of this. Rocket Internet, you know Rocket Internet is responsible for Jumia. Jumia is very popular in Nigeria. Rocket Internet was a public company, but decided to leave the public markets because they were getting beaten because of the fact that they were missing targets quarterly, repeatedly. And so this is the trend. And they were able to go private because of support from private equity firms, private equity funds, my apologies. So we had to look at this. We had to examine, we had to be able to determine this with some measure of accuracy, the effect of private equity funds on companies going public anywhere in the world, but we focused on the UK. And we found that the growth in private equity financing is linked to an annual decline of 2.4% in the number of IPOs in the UK over a sample period. That is significant considering the fact that over the previous decade of our data, only about 82.2% of companies were going public annually anyway. So that is significant. And we also are able to ascribe the rise in private equity financing to about 1.55% decline in the proceeds from IPOs themselves, and also 12.73% decline in IPOs as a proportion of publicly listed companies in the UK. Now, this is important because this is relative to the value of all the companies that are listed. And this is exactly what shows you that even when companies are going public, there are tiny companies that are, for the most part, not very consequential for the stage, for the size of publicly listed companies. And also, the growth in private equity financing is linked with 8.82% in IPOs scaled by the size of the UK economy in GDP terms. This is also important because it helps us capture the impact of IPO prevalence on the UK economy as a factor. I think this is pretty much my last slide. So, but this slide is still talking pretty much about the rise in private equity funds, but it's also focusing on the fact that most of those private equity funds are coming from different parts of the world rather than from the UK itself. And it's not just the UK that is susceptible to this. I'm sure right here in Nigeria, there are private equity funds coming from the United States and buying up and providing support for a lot of innovative companies. And this is a trend we can expect to see more of. This is just in the case of UK. In 2019, private equity funds raised a total of 47.59 billion pounds to spend on taking companies private or to spend on helping private companies stay private for longer. And we can see that 39.5% of that was raised from North American markets. You can replace North American markets with the United States. I don't think Canada doesn't have a significant part of this. And another one we should watch out for is Asia Pacific. And also from the UK continental shelf, about 11.35%. That's pretty much all I have time for. I'm aware of the fact that I have just about 56 seconds left in the extra time I've been given. And I just want to spotlight this. We're hosting a FinTech conference in Edinburgh next year, and you are all invited to attend. Thank you very much for your attention, and I look forward to catching up on the sides of the conference to discuss this. Thank you very much. It's been a pleasure.